Getting access to capital can help you grow your business, but it can be tricky to fundraise if your startup is still in its early stages. Many institutional investors are reluctant to put money into companies that don't have at least one or some history of revenue or growth. Fortunately, you have options. One of the most common ways early stage companies raise money is with convertible notes. I'm Winnie Kisache from Monkey Pesa. And before I tell you more about convertible notes, what they do, who they are, I would like to tell you something about our CRM software.
As a small business owner, you have a lot on your mind that it can seem out of control. You've got to go through the marketing process, then react to your leads, set up meetings, sales pitches, respond to emails, texts, phone calls, social media messages, and for one, that can be exhausting. So what can you do about it? For a start, you can subscribe to the Monkey Pesa Sales and Marketing Hub that would help you put all your customer correspondence in one place. Send emails and texts, set up meetings, make calls, hold video meetings, and more all in the same place. Try it today by going to dashboard.monkeypesa.com and signing up. Monkey Pesa Business. Simplified.
So what is a convertible note? A convertible note is a type of investment that lets founders raise money from investors without having to conduct a formal company valuation first. Unlike a priced round, which is an equity investment based on a valuation, a convertible note is a short-term debt that has the potential to convert into company equity at a later date. Though valuations can give you a better idea of your company's worth and growth potential, they also force you to put a price on your stock. That's why many founders like the idea of convertible notes. You have more time to see how your company will evolve before setting a price per share. So how do convertible notes work? If an investor believes in your company, they can give you a loan in exchange for a note in the form of a convertible debt. The note then turns into shares of preferred stock upon a qualifying event or transaction, like the closing of a Series A round of financing. Convertible notes are designed to reward early investors for their risk, which is why they typically come with a valuation cap or conversion discount. A valuation cap sets a maximum valuation at which an investor's money can convert into equity. This cap, which determines the company's price per share, holds true for convertible note holders even if later stage investors pay a different price. A conversion discount, on the other hand, gives investors a discount on the price per share when their note converts into equity. That means they can purchase shares of preferred stock at a lower price than investors who come in during later rounds. If a convertible note includes a valuation cap and a conversion discount, the note holder typically gets to choose whichever advantage gives them the lowest price per share. Because a convertible note is a form of debt, it also comes with terms that help protect the investor, including a fixed interest rate and maturity or expiration date. Convertible notes typically accrue interest at a rate of 2 to 8% depending on your location. If a convertible note hasn't already converted to equity, by the time the note expires, you have to pay back your investor's principal investment plus interest. Of course, you can always opt to extend the maturity date, but you have to get your investor's permission to amend the note. SAFE versus convertible note. Many people look into SAFEs as an alternative to convertible notes. SAFEs and notes are similar in that they both convert to equity, but the process is different. SAFE stands for Simple Agreement for Future Equity. SAFEs convert into shares of stock in a future priced round. Unlike convertible notes, which don't convert into equity unless the company raises a specific amount of capital, SAFEs usually convert into equity during the next priced round, regardless of how much money your company raises. Another difference is that SAFEs aren't a form of debt. They're considered a warrant instead. Because of that, SAFEs have no maturity dates or interest rates, which can be better for founders. However, They do usually have a valuation cap or conversion discount investors can take advantage of. Both convertible notes and SAFEs are good options for founders who want to get funds quickly. However, convertible notes tend to have more protections for investors, which can make them an easier sell. Now, what are the advantages and disadvantages of using convertible notes for financing? Like any fundraising strategy, there are pros and cons of using convertible notes to finance your company's growth. Number one, you save money and time. A convertible note term sheet is shorter and more straightforward than a priced round term sheet. When you don't have to negotiate as many terms, you save time and spend less in legal fees. Number two, notes are simple. You can change the terms of the note fairly easily if you need to. Number three, you retain control over your ownership. You don't need a lead investor to help secure more funding. Number four, you may not have to conduct a valuation. If you want more time to see how your company will grow, you can hold off on a valuation until the next round of fundraising. Finally, notes appeal to investors. Investors may be more willing to take a risk on your company because they are protected by the note's valuation cap or conversion discount. So what are the disadvantages of convertible notes? Number one, you have to be careful of dilution. If you raise too much money using convertible notes, or if the notes convert at a low valuation or with a significant discount, your shares of stock as a founder may be diluted. Number two, you may have fewer investment opportunities. Without a lead investor to drum up interest in your company, it could be difficult to find and secure other investors. Number three, you could still end up doing a valuation. If you decide to use a valuation cap on your convertible notes, you will likely have to conduct some type of pre-money valuation, which could force you to put a value on your company earlier than you wanted to. So let's talk about financing your company. Fundraising for your company can be complicated, so it's crucial to gather as much information about your options as possible. In addition to consulting your accountant and business lawyer for advice, make sure you take time to review your goals, discuss strategies with your team, and read up on the fundraising market for your industry. Convertible notes might be a great option for you to raise money during your seed round if you want to fundraise quickly, you want to save money in legal fees, you want more time to see how your company will grow before doing a valuation, and you want to retain control over the fundraising process. And as a bonus, you're prepared to pay interest on the note. If you like the flexibility of a convertible instrument but don't want to deal with accrued interest on your investment, you could also consider using a SAFE instead. However, if you want a better idea for your company's ownership and dilution, you may be more interested in the traditional path of a priced round. No matter which route you choose, make sure you carefully weigh your options to figure out what makes the most sense for your company's immediate and long-term growth. If you enjoyed this video, please click the like button and don't forget to subscribe to this channel. We have more of these videos for you. And until next time,